Hello everyone, and thanks for tuning in to the Financial Investor channel. My name is Brent, and today we're going to be going over 5 stocks with ex-dividends next week. We're going to be talking about whether they're overvalued or undervalued for their current yield to price. We're going to look at their 1-year, 5-year growth, their payout ratio, and their dividend history. We'll also talk about their dividend growth, and so on. So I have 5 stocks for you, all with ex-dividends coming up next week. And if you're brand new to my channel, I make stock market, ex-dividend, investment videos daily, so consider subscribing to my channel. And the very first stock that we're going to start out with is Aflac, ticker symbol AFL. Now, Aflac is an American insurance company, and that's what it's really well known for. So Aflac, taking a look really quickly at its price to yield, we can see that it's priced at $80 and its yield is 2.10%. So right now the yield is way at the bottom compared to its price, so it is overvalued at this time. Now let's quickly take a look at its 1-year and 5-year. So ticker symbol AFL stock, and 1-year growth is 11%, so really great, matches right with the S&P 500 and has a yield of over 2%, just like the S&P 500. So this would be a nice one to your portfolio for the 1-year. Let's take a look at its 5-year. So 5-year has a growth of 75%. So what's 75 by 5? I think that's 15. 75 by 5 is 15% per year, plus you're getting that yield back of around 2%, so that is amazing growth with its average of 15% back per year. Let's go over to dividend.com and let's take a look at its payout ratio, and it was ticker AFL. So payout ratio under 30%. So I like to have a payout ratio of under 60. This is a payout ratio of 25.9. That means that they're only paying out 26% of their earnings back to their shareholders, and they're reinvesting the rest of the 75% back into the company. So that is really great. Next thing I can just automatically see is they have dividend growth for the past 34 years. So this company has been through multiple recessions, and it has continued to increase its dividend payout. So another great thing to look at there. Its ex-dividend is next Monday, so you do need to buy it by this Friday in order to get paid out on September 1st. You would then receive a payout of 43 cents for every share, and they're currently priced at $80.82. So that's actually a really nice price to pay out. Let's see, take a quick look at their growth here. So their annual growth is 5.1% in 2016, and let's see here, 43, 43, 43. Let's increase this real quick. They were 41 and 43, so 0.43 minus 0.41 divided by 0.41 times 100. So their growth is 4.87% now. So their annual growth averages around 5%. It's actually starting to decline this year, so that could be an indicator. I'm not sure why they did increase it by as much, because their payout ratio is so low. They should be able to continue to grow it out a little bit. So this one does have a pretty low dividend growth, but of course they have continued to pay out dividend. They have had dividend growth for 34 years, but their annual growth for dividend is around 5%. So they could definitely bump that up in the future. And I don't see any stock splits right here. They have done stock splits in the past. So there were some stock splits here where they split their stock and then they continue to pay out the same dividend. Looks like they cut back their dividend one time when they did a stock split, but then they raised it back up to 3 cents. They did another stock split, but they considered to pay out. So if you held this stock and they did a stock split, they would probably pay you the same per share when they give you 2 for 1. So this could be a good one to add to your portfolio for the future, in the long term. For another 30 years, do you think an insurance company will still be around and needed? Yes, I believe so. And Aflac, they have commercials about the duck, so pretty well known. Next company is Delta Airlines, DAL. right off the bat, I can see that their price to earnings is undervalued in this chart, and this yield is really wrong right now. It says that it's 1.62. It's actually much higher. They just increased their dividend by 50%, so they are now paying out double what they were paying out previously. We can see that they're $50, and let's go take a look over here. Let's go take a look at their 1-year and 5-year growth. So we can see right here, dividend is 2.43% versus this chart showing 1.62. So this one is correct. They've had a growth of 33% in 1 year. That is huge growth. And 5 years, 449%. That is that is a lot. That is a lot. I can't do that math in my head. What was it? 449. So 449 divided by 5. So they're averaging around 90% growth per year, plus their dividend yield increased by 50%, which brought their price to, just look at their price to earnings, 9.95%. In this industry, in the airline industry, their price to earnings ratio is around 11 or 12. So this is actually a great time to buy Delta. It looks amazing. Let's take a look at its payout ratio really quick. So DAL payout ratio 22%, so way under my 60% rule. This one has a lot of room to continue to grow. They reinvest their earnings back into their company. They've only had dividend growth for 3 years, but they have only paid out dividends for the past 3 years. So we can see, let's see here. They started paying dividends in 2013, and you can see that ever since they began paying out dividends, they have increased it. And because they had so much cash on hand, they actually decided to increase their dividend here huge, from 14 cents to 20 cents, from 20 cents to 30 cents. So 20 cents to 30 cents is a 50% growth right there. And so right here, annual growth for 2016 was 50%. Annual growth for 2017 was 50%. So this could be a great one to buy and hold. And you're buying it at a discount at $50 right now, where you're getting paid $1.22 per share, and only payout ratio of 22%. So they can definitely continue to grow their dividend and continue to pay out in the future. This is one. Their payout date is their ex-dividend date is the 21st, which means you do need to buy them on Friday to have them in your portfolio by Monday, and you would get paid out on September 13th. And I believe they've done stock splits in the past too. No, they have not. They're fairly new to the dividend club. Next stock is Triple M. So this is a multinational conglomerate, and let's see here. They are way overvalued right now. $200. If you would have bought them in November of 2016, you could have got in at $171, and that would have been $30, almost $40 gain per share as of November of 2016, where their yield was over about 2.65%. That would have been optimal time to buy. You can see that ever since the elections, they have just been shooting up, and they may have had an earnings issue here in July where there was a huge dip, but then it looks like they're recovering again. But again, this one, looking at it, is very overvalued. Let's see here. Let's take a look at their 1 year and 5 year. So 1 year average is 15%, so definitely beats the S&P 500. 5 year is 120%, so that's 120 by 5 is 26. 120 by 5 is 24. So average 24% growth per year, which definitely beats the S&P 500 over a 5-year period. Plus you're getting that dividend yield of 2.26%. So it really is a great buy. You can see that its price to earnings is 23.7, so it's not terribly bad, but right now, just looking at their charts here, it is considered overvalued in my eyes. Let's go over to dividends.com. Take a look at their payout ratio, and their payout ratio is under 60, so another one that makes my rule, and has had continued dividend growth for 58 years. So that is amazing. Their ex-dividend date is Wednesday, so this is actually one of the first ones that is not on Monday. So this one you need to buy next week Tuesday in order to have in your portfolio for Wednesday, and then you would get the dividend pay on September 12th. Their annual growth is 8.3%, so that is huge annual growth. It's not quite 50, but it's better than 5. So really good dividend growth. Good growth, good growth. You can see they went from $1.11 per share to $1.18 per share. So great growth. That's really great growth. Next stock we're going to be taking a look at is Hershey's. So ticker symbol is HSY. This one currently is undervalued. It's slightly undervalued. You can see their yield is 2.33% and their price is $106. If you were to bought them in November, you would have got their yield of around over 2.4%, but it's really not terrible. You can see that this one swings left or right between bottoming out at $95 and topping out about $115. So right now you're buying it pretty much in the middle, and it could go either way. So this one could go down, and you could consider in the future average down your investment, and then as it bounces back up again, you would make that gain back. So your dividends being reinvested in the Hershey's could, increase your average yield if it were to continue dropping back down. So it's not really overvalued, it's not really undervalued, it is kind of in the middle and undervalued. So let's take a look at its 1 year and 5 year. 1 year looks like it had a negative about 6.52%, but its 5 year it's had 47%. So average of around, what is that, 8 point something percent, so 47 by 5, let's say 47 by 5 is 9.4% per year average. So that one's pretty much in line with the S&P 500, along with its dividend yield of 2.47%. So this one might be something, if you were to add it to your portfolio, you would definitely want to assess it as far as what its future holds for it, what they're planning, what the CEO is doing to continue this sort of trend. What issues have they had during this year that they've had a negative 6.52% loss during this time where the economy is booming. All the other stocks that we've been covering have had huge growth. So let's go over to dividend.com and take a look at their payout ratio. So let's see here, they pay out 54%, so under 60%. That means they are one of the first ones that isn't paying out. They are paying out over 50% of their their earnings back to their shareholders. They have had continued dividend growth for 7 years, meaning that during the 2008 recession, 2010, 2008, they had to stop increasing their dividend payout. That way they could, build their company a little bit. Maybe they had a couple issues back then. So this one is their ex-dividend date is Wednesday, so you need to buy them next week Tuesday in order to get paid on September 15th. And we can take a look here at their chart. That they have had multiple stock splits where they decreased their dividend here for a stock split and then raised it right back up right away after they saw that they could continue paying out that ratio, and they did another stock split here, and then they continued to increase their dividend. So if you had 100 shares, you would now have 200, and then you would get paid 22 cents per share. So you can see that during 2008 to 2010 they did not increase their dividend payout, so they continue to pay out 30 cents per share. And our last stock is Johnson & Johnson. This one has a great history. Right off the bat, I can see that their price greatly outweighs their yield right now, so they are considered overvalued at this time. Taking a look at their 1 year and 5 year, we can see that their 1 year growth has been 10%, so in line or over with the S&P 500 with that dividend yield of 2.5% right now. Their 5 year growth has been 97%, so we'll say 100 by 5, 20% average per year. So that is definitely double on average what the S&P 500 would give you, plus their dividend yield is higher than the S&P 500. So this would be a better investment than putting your money into the S&P 500 over the past 5 years. So let's take a look over at dividend.com and look up J&J. Take a look at their payout ratio. And they pay out 46%. That means that they're investing 43 or 53% back into their company to continue to grow it and develop their multinational medical devices. They've had continued dividend growth for 54 years. So all of these stocks that we've been checking out today, besides Hershey's, has had, and Delta, I think Delta was 7 years, have had dividend payouts for over 20 years. So Aflac, Triple M, and Johnson & Johnson have paid out through multiple recessions, and we can see that this one has an annual growth of 6.8%. So not bad, not amazing, but it's been paying out dividends for 54 years. So if you bought and held this one, do you think it would be around in another 20 or 30 years? I think so, very much. And of course we can see here that they have had stock splits in the past, but they never cut back on their dividend. They did here, but then they doubled again. They increased it by 50% after they saw that once they did a stock split, they could continue paying that dividend payout, and then they bumped it back up to normal, to in line. And of course, through the recessions of 92, 2000, 98, they never cut back on paying their dividends. So really great stock. These are all 5 of them. So Aflac was overvalued. Delta was undervalued. They increased their dividend payout by 50%. Triple M was overvalued. Hershey's, or Triple M, yeah, Triple M was overvalued. Hershey's was not overvalued, not undervalued, but they have had cutbacks in their ex-dividend. And then Johnson & Johnson is overvalued, but of course they've had that dividend growth for 5 years. So those are your ex-dividends for next week. Aflac, you have to own it on Friday. Delta, you have to own it on Friday of this week. That way their ex-dividends are on Monday. Triple M and Hershey's, you must own them on Tuesday of next week because their ex-dividend date is on Wednesday. And Johnson & Johnson's ex-dividend date is next Friday, so you must own them on Thursday of next week. So that is it for this video. I know we covered a lot of information. I try to get it out there quick, that way not to make the video too long. So I want to thank everyone for watching up until this point, and if you liked the video, hit the like button, and please remember to subscribe for future financial videos. If you have any questions or just want to say hello, please leave a comment and I will always reply. Thanks for tuning in, and I will see you next time. Bye.